everyone, welcome back to Alpha Insights. I'm Brittany, and we've got a neat company under the microscope today.
And I'm Joe. Good to be with you. We're digging into Coca-Cola and the classic debate, steady dividend versus uncertain growth.
And hey, if you have questions while you're listening, drop them at stockalpha.ai. We'll try to answer as many as we can.
Right, so quick headline for listeners. Coca-Cola still looks like a fortress of brands and cash flow. But the valuation is hardly a bargain, and there are real questions about volume and dividend coverage.
Exactly. The short version: iconic drinks, steady margins, reliable cash, and a dividend that people count on. But growth is moderate, and some analysts are asking if that dividend is fully backed if volumes slip. So, the real question here is, do you pay up for that stability? Or does the limited growth make the stock look fully priced?
Well, when you look at the fundamentals, Coca-Cola generates really strong free cash flow and a very high return on equity, which is where the dividend story comes from. But the price multiples are in the mid-20s, which already reflects a lot of that stability.
Right, and that shows in how analysts talk about it. Many call it a buy for income and safety, while others flag slower unit volumes and promotional pressures in some markets.
Yeah, that's a good point.
Let's break it down. On the plus side, iconic global brands like Coca-Cola, Diet Coke, Sprite, and a wide portfolio that includes juices, water, sports drinks, and expanding low-sugar lines. That brand muscle buys pricing power and shelf space.
And the franchise bottler model is huge. They're mostly concentrating on concentrates and marketing, letting the bottlers handle distribution. That means lower capital intensity and consistent margins for the parent company.
Exactly. The company also converts a lot of sales into operating cash. That cash funds the dividend and buybacks, and it's why investors keep trusting the payout. At least so far.
Which explains the dividend headlines. People love a steady payout, especially in a low-growth part of the market.
But now, the caveats. Volume trends have been mixed. Pockets of softness in some regions and categories. If volumes stay weak, the company might have to lean on promotions, which would squeeze margins and cash flow.
Right, and input costs or logistics inflation can chip away at margins too. So even though the balance sheet is investment grade and liquidity looks okay, pressures on cash flow could change the dividend math over time.
So, what about valuation? Analysts are pricing in a premium for that margin durability. Using a forward price-to-earnings band gives a fair value somewhere in the low to mid-70s per share, which suggests limited upside from current levels.
That's the tricky bit. The trailing earnings and a forward multiple in the low 20s make the stock look like it's already reflecting a lot of the positives. In plain English, you're paying for reliability, not for a high-growth story. We should also flag competition. PepsiCo isn't just a rival in drinks. Their snacks business gives them diversification that Coca-Cola doesn't rely on. And fast-growing energy brands are nibbling at market share in the high-margin segments.
Yeah, and innovation is a wild card. If Coca-Cola's new low-sugar and functional beverages catch on more broadly, that could expand addressable market and offset some softness. But that's execution risk. Marketing and route-to-market investments need to pay off.
On the near-term front, remember there was extra scrutiny around the dividend after a payment earlier in the year. Analysts will keep an eye on payout ratios and what management says about capital allocation.
Exactly. So for anyone watching earnings or management commentary, the key things to look for are organic volume trends, pricing cadence, margin trajectory, and any shifts in buyback or dividend language.
Short-term traders might see some moves around those updates, while longer-term holders should track the payout ratio and whether innovation can generate sustained growth.
Interesting. Quick technical note. The stock has been trading in a relatively tight range between the mid-60s and low 80s. Low volatility, low beta. That's consistent with its defensive reputation.
So the bull case is margin expansion, successful product innovation, and analysts staying bullish on the dividend. The bear case is persistent volume declines, rising costs, and multiple compression toward the low 20s or high teens.
Right. And just to be clear for listeners, we're laying out the scenarios and data, not telling anyone to buy or sell. Analysts note both the stability and the risks, and the market is pricing those in.
Exactly. Informational only. Everyone's situation is different, So think about sizing, time horizon, and risk management if you're watching this name.
Okay, time to wrap up. Joe, what are your top takeaways?
1. Coca-Cola is a high-quality, cash-generative business with durable brands. 2. The valuation already bakes in a lot of that stability, so near-term upside looks limited without a re-acceleration of growth or clear margin expansion. 3. Watch volumes, dividend coverage, and management's capital allocation.
And from me, watch the innovation pipeline and category data in sparkling and energy drinks. Keep an eye on promotional intensity and input costs, and remember that this is a defensive name, not a high-growth play.
Got questions? We'd love to hear from you. Head over to stockalpha.ai where you can ask us anything and we'll answer live. And while you're there, check out more market content and our Q&A feature.
Perfect. Thanks for listening to Alpha Insights. Catch you next time.